Welcome, dear viewers, to the third talk of our YouTube series being held from 10th to 16th October as part of the World Investor Week. Harmony Talks is bringing the session to you live in collaboration with our partner BSC Investor Protection Fund. World Investor Week, an initiative by the International Organization of Securities Commissions, is a global investor awareness campaign that witnesses a host of investor awareness activities. In India, it is held under the auspices of the market regulator SEBI. As part of this, Harmony Talks, in collaboration with BSC Investor Protection Fund, has put together a series of fireside chats with industry leaders, a YouTube talk series, financial literacy sessions, and the like. Today, I am pleased to introduce to you our speaker for the day, Ms. Shamli Basu, Executive Vice President and Head Products, Trainings and Marketing at HDFC Asset Management Company Limited. Shamli has over 28 years of experience in sales and distribution, equity research, and property consulting. She has been with HDFC Asset Management Company Limited since January 2001. She has done her BA and MBA in finance from Delhi University. Welcome, Shamli.
Thank you so much, Hemant. Thank you.
Thank you, Shamli. Pleasure having you here as we start off the third talk in our series. So today's topic being equity investments as a wealth creation tool. Now, this is a topic that has been discussed in the past, but what we have attempted to do here is try to explore some not often discussed aspects of equity investment in terms of creating wealth for investors. So equity, as we know, is a very good long-term wealth creation tool. The Indian equity markets appear bullish, despite some volatility this year, where we saw the Sensex breaching level of 61,000 on the upside, as well as on the other side went down all the way to 51,000 plus. So broadly speaking, where do you see the Sensex or the Nifty 50 heading in the next year and the 2 years after that?
So, Hemant, there are, I've often quoted that there are two types of people. One who know that they don't know, and one who do not know that they do not know, right? So we know that we do not know the fate of equities in the short term, right? 1 to 2 years, because it is largely driven by sentiments. It's largely triggered on exaggerated on both sides, whether it's optimism or pessimism in the short run. And there's also a saying that it's not a voting machine, it's a weighing machine, right? Which you have to give time to. So when you yourself said that equity is a long-term investment asset, as per many international investment gurus, they say that equity investment should be a lifetime investment. So in the long run, talking of now what I have just said, you would then say you don't need a mutual fund person with 21 years of experience in AMC to talk that way. But in the long run, so let me just share a slide with you. Equities have delivered as much as the nominal GDP. Okay. When I say nominal GDP, it is inflation plus GDP. So can you see this slide, Hemant?
Yeah, we can.
Right. So what we have done is we have broken the decadal growth rates in India. Okay. And we have done 81 to 90 in the first bar, where inflation was at 8.5% and GDP growth, real GDP growth was about 5.5%. And the nominal GDP was the addition of the two, which is about 14%. So if you see what equities deliver over the long term, equities is one asset which helps you beat inflation, which means it is certainly higher than inflation. And it's a slave of earnings, which means it will grow as much as the GDP. So by and large, in the long run, equity returns will give you as much as the nominal GDP or inflation plus GDP. Of course, there are other factors, but that is what one should expect. But in each of the decades, if you see that graph, there are events which almost give you the impression that the world is going to end. And since we are talking today in not the recent I mean, not in very far past, but COVID was one such example where people thought that it is all going to come to a grinding halt and the world is going to end, right? And markets did correct. However, today, if you see that, where is it from pre-COVID to post-COVID? We have only gone ahead in every which parameter, right? So we feel that going forward too, India looks extremely well poised. And if I were to invest in equity, one has to look beyond 1 to 2 years. And what is the real expectation of equity? Let's not compare the COVID year for those who have invested in 20 and redeemed at 100% growth or almost 100% growth. But in the long years, in the long term, it will stabilize to almost like a normal GDP return, which should be around, say, anywhere between 12 to 13 odd percent. So sorry not to give you a direct answer, but that is actually the answer.
No, that's actually beautifully put because let me tell you, Shamli, why this question came about. The reason is that we keep hearing a lot from our community members and retail investors in terms of, for example, if I can give you the parallel of the so-called uncertainties that came about in the minds of investors during the period just before or just when the pandemic hit, right? And that's when we saw in March of 2020 that there was some 30 to 35% drop. And then
Yes,
immediately investors were like, okay, what's going to happen next month? Not even, it's not even about quarter, right? Not even about, so next, what's going to happen next week? So there are uncertainties playing around the mind. Should I kind of pull out my investments? Should I come back after the entire pandemic is over, even if it's a few years? So these kind of questions came about. And then
sure.
again, this year, we had another talk in the same series where we were discussing about the impending global recession, slowdown, global slowdown, etc. And that's where again we started hearing a little bit of pockets of question here and there that okay, now what do I do with my investment? What will happen next year? Should I put off my planned investments to next year or the year after that? So these were kind of questions came about. But
Certainly.
your point is taken. We should not be looking at equity investments from a short term perspective of 1, 2, or 3 years. It really goes against the ethos of financial planning, so to speak, for the retail investor. So I think that was beautifully put. I hope our viewers got the essence of what it really means in terms of equity investment vis-a-vis the investment horizon.
And I will share this slide with you because if you see each of these decades, there are almost so many occasions. We have outlined anywhere between 5 to 10 events which have happened in that decade. And believe me, in each of those 5 to 10 events that have happened, whether they were political, geopolitical, or whatever, uh, we have seen assassinations, recessions, boom, bust, etc. Every time we thought, oh shit, am I invested in the right asset class or not? Should I move in, move out? So those questions, if it's for the long term, as you said, wealth creation, don't worry. As long as you bought into good growing businesses, I think you're insulated for the long term.
Okay. So let's move on now. Now that we have seen that what should be the investor's mindset when it comes to the investment horizon itself. Now, coming to some specifics, the real estate as a sector or as an asset class has kind of lost its steam. It's been facing lukewarm demand over the recent years. There's a lot of pent up inventory. Demand for new units has not kept pace with historic trends in the real estate sector. Much of the money from that sector has flowed into equity. Um, we can debate the percentages, but it's a fact that a lot of money has flowed into equity from the real estate sector. Now, how much of this has been invested in mutual funds as opposed to being invested directly in equity? Number one, and number two, is this trend of uh, real estate money or money planned for real estate investments moving into equity, is this trend going to sustain for the next few years?
So the problem with real estate, Hemant, is that real estate does not have an index the way equity has, debt has, gold has, right? So real estate is very, very localized. It depends from builder to builder, city to city, right? You may be in one building and your adjacent building may be fetching a different square foot rate, right? So it is very difficult to make a generic statement about real estate. However, having said that, every Indian aspires to own one house where one would live in, right? And we are not in the American mindset where we wouldn't mind staying on rent, though the newer generation is pretty much there, where they don't mind taking a Uber instead of owning a car, or living on rent and enjoying their life because the rental yields are very, very affordable, instead of buying a house and tying yourself for the next 20 years, right? As the case may be for a home loan. So the problem with real estate is that there would be plenty of people who will say, oh, I made tons of money in real estate. However, there'll be very few when you talk to investors who will say, oh, I haven't made money at all, because real estate is a love for most Indians, right? People think it's very easy to make money. However, real estate cycles internationally and even domestically last for very long. As you rightly said, the recession or the trend, though somehow the numbers are improving in Mumbai at least. I don't know about the city you're in, but numbers of registrations in Mumbai have shot up. So typically a real estate cycle lasts anywhere between 8 to 10 years, right? And when interest rates were low, affordability was very high in the recent past. It's only now that the interest rates have started to go up because inflation is going up, where home loans will become more and more expensive. However, having said that, real estate for your self consumption is acceptable. But real estate, unfortunately, is not a vehicle for wealth creation. The reason for that is you try and sell a real estate that you own, you will find 1,000 reasons why the price will not be what you want it to be. Okay. Then the transaction cost of entering and exiting real estate is very steep, right? And it's a very large investment. Somehow, for the love of real estate, people don't realize their largest pool of savings goes in real estate. So if it is for consumption, I understand. However, if it is for investments, in our minds, that is, it's a very personal choice. However, when we talk to our clients, in our minds, it does not make sense to invest in real estate. Now, there is no catalog which speaks with authenticity as to how much money from that sector, which was lying in the banks, has come to mutual funds, stroke direct equities. But one thing is for sure, while COVID or pandemic was on, this was a trend not only in India, but the world over, where most of the elite people, see, some people lost their jobs and pandemic hit them very badly, right? So, but some of them had higher disposable income because A, they were at home, B, they had no source of spending it, and world over, the number of equity transactions went up, and so was the case in India. So we have 10 crore equity demat accounts, right? We have, however, retail flows have started to happen in mutual funds, and that's a very encouraging trend. So even in the last month, SIPs are almost nearing 13,000 crores, which is extremely encouraging. So people are realizing that equities eventually will give you a very high, I would say, a better return than most assets. Now, if you see this, the lower chart, if you see the green bar, the yellow, blue, and red bar, can you see that, Hemant?
Yes.
So what we have done is we have taken since 1979, that was when the index BSE Sensex got conceived, till March of 21, okay, we have taken the value, sorry, March of 22, we have taken the value of the Sensex, we have taken gold's return, bank FD return, and inflation return. So for those who cannot read it, I'll just repeat the numbers. Equity has delivered 15.5%. Gold is about 8.5%. Bank FD is about 8%. However, the inflation was about 7.5%. So very clearly, my vote would go for equity, largely because it's easy to liquidate, it is transparent, You know what you're buying, you know what you're selling, you know the price at which you would enter and exit. And it has the capability or the characteristic to beat inflation by the highest margin in the long term. This is long term again, right? So, if one, so my only piece of advice for whatever worth is that if you are looking at real estate for investments, rethink, please. However, if you're living, wanting to buy one because interest rates are still lower and you feel it will go up further, please invest in it. However, if you're interested in wealth creation and an easy mode to create wealth, to diversify in various businesses instead of putting all your money in one flat or commercial property, then look at investing in equities.
Perfect, Shamli. So I think that gives a lot of perspective in terms of how to look at real estate, and because there was a sense that at least pre-pandemic, the sense was that maybe from 2014, 2015 onwards, there was this phase where real estate consumers, so to speak, who were wanting to buy their first house, or maybe even some of these real estate investors, or so-called uh, consumers slash investor who are looking for the second home purchase, we're actually trying to time the real estate market by saying that, okay, I know that real estate prices are dipping, so let me try to wait it out. Maybe there's going to be a, this is not the bottom yet, let me try to kind of roll down, slide down to the all the way down to the bottom, but nobody knows where the bottom is, right? So maybe some of the purchases of real estate inventory kept getting perennially postponed,
Right,
and maybe we saw a lot of demand dipping because of that. But I think your answer puts that in perspective in terms of for the investor, how to look at real estate purchase. And definitely, yes, if you're looking at real estate as an investment, that's a slightly dicey area instead of looking at it as a consumption. So now that we talked about real estate, let's come to mutual funds. You were talking about mutual funds, and we have the convenience factor for mutual funds in many on many fronts. Mutual funds are convenient, liquid, etc., and they give you this the flexibility, and they give you the diversification of equity, etc. So as a vehicle of equity investment, mutual funds had gained immense popularity in India, especially 2000s onwards, and especially in the last decade. Having said that, if you look at the historic returns of, for example, debt funds have delivered average return of 8 to 9%. Equity funds, on the other hand, have done just marginally better, maybe at 10 to 12%. Uh,
what
there's
time
this,
frame are you seeing? I just read up. The equity was about 15 half. However,
yeah, it depends on the time frame. Maybe if you're looking at
yeah,
a, yeah, if you're looking at
yeah,
maybe a smaller time frame, these percentages can vary. But we are looking at an average of, because we don't want to our investors to kind of get into that quick mode, quick purchase kind of thing, thinking that I'll make quick money with equity. So we kind of tend to, as a philosophy at Hermit House, we try to kind of tell them that if it's mutual funds, you can expect around 10 to 12%. That's what we normally uh, tell, and 14 to 16% for equity. But of course, it depends on the time factor, also the investment horizon. So, having said this, there is a sense that newer demographics, right, newer cohorts of population, investors looking for something more than what mutual funds themselves can provide, are all looking for some other options where returns can be higher than what the percentage that we just talked about. So there was one school of thought that portfolio management schemes, PMS, could do that for investors. So is PMS the new mutual fund? Number one, or do PMS and mutual funds have their own captive audiences? They have, each of them have their own place in the scheme of things.
so it may sound very rude to a few people. Okay, but pardon me for saying so. I'm a little blunt here. Why does a person take PMS? Okay, let's just take this. I mean, I will give you 5 factors why mutual funds score above PMS. Okay, let's just first start with that. The minimum in mutual fund is 100 rupees in most mutual funds, right? However, the minimum is 50 lakhs in PMS. AIF is a crore. Okay. Mutual fund is extremely well regulated and transparent. I mean, we have to even upload our transactions on AMP website. So it's an extremely transparent vehicle. However, PMS is not as transparent at all. Regulation is similar. PMS has higher fee than a mutual fund. Mutual fund is now tagged to AUM. The larger the scheme, the smaller is the expense because of economies of scales that AMCs enjoy because of the size of the fund. PMS cannot be as diversified as a mutual fund, correct? It will have a focused portfolio. Now you tell me, why does one take PMS? Okay, there are some valid reasons and some snooty reasons for the same. Okay, sorry, again, I said pardon me for saying so. Valid reasons are where a person has a large equity portfolio skewed towards, so maybe if since you're calling from Bangalore, let me just give you a tech example. So say I'm working for a tech company and I know I have large tech related ESOPs and I want my portfolio non-tech to insulate myself from tech movements. I'll say, okay, fine. Can you make a portfolio for me? And you can exclude tech because I already have a lot of exposure to tech. Now, those kind of requests are very welcome in a PMS, but unfortunately, a mutual fund doesn't work like that, right? So for those kind of investors where genuinely it is for a reason, I can yet understand. However, most people feel that something which is so common and simple and which even a small auto guy can afford, I have more money and therefore I should earn a little more. That is the reason for which most investors look for something different. Okay. This is okay. This I know I have SIPs, I understand everything. But what additional can I earn? Is there is no proven fact that over long-term PMS returns have been higher. And PMS is less tax efficient also. Sorry, the largest component is tax, right? There is no proof that a PMS has outsmarted a mutual fund manager, right? However, people want something new. So why are NFOs sold? Kuch naya batao. Ye to hai invested. It is not the NFO, it is equity which is important, right? So if you have done something simple and you live life peacefully, that will also create wealth in the long term. And if you do something more complex, and if you keep asking your fund manager, oh, what have you done? Oh, this stock is done well, this is not done well, remove this, and you want to do your own discretionary, non-discretionary mix up, then you take that. But is there an empirical proof that one has been better than the other? If you see the long term, no. There could be some periods where, so mutual fund is more diversified, right? So when it's a narrow rally, maybe a mutual fund have missed it. But in the long run, if you add all factors put together, personally, I don't see any merit in a PMS at all. Unless, of course, as I said, it's a defined objective, which a mutual fund cannot serve. Otherwise, I'm not for, I mean, I don't have a PMS myself.
Yeah, point taken. The uh, what do you call? If I take a step back, the rationale behind looking at PMS was not really to compare with MF. You're right that these are slightly apples and oranges, because it really depends on the ticket size and the appetite of the investor to do something. Let's
Different.
say, does he want to stick with what we call? I mean, there was one other talk where I remember those the terms boring investing and exciting investing. So some people with the big ticket mandates may be looking at something exciting,
So,
but
so I think Warren Buffett has said money making is extremely
is it
boring.
more?
It's like seeing a freshly painted bench dry up. It's
Yeah,
as boring as that.
yeah, and the most what do you call that? The most lucrative things to do require discipline, which itself by definition is boring. So this is what we tell our investors, our committee members, that it doesn't depend on what innovative way method you take to invest. It just depends on the discipline you put in, and of
Precisely.
course discipline can be quote unquote boring.
Yes.
But to come back to your point, that was the rationale behind which, I mean, there were certain
Yes.
populations, maybe they are in the minority, maybe they are in the single digits in terms of the population percentage, HNIs and so forth, who or maybe well-earning members of the, like you said, maybe sectors like IT or biotechnology, etc., who may be looking at PMS, not maybe not as an alternative, but maybe as an add-on to
Possibly.
explore
Possibly.
certain opportunities. So that was the rationale, and I'm glad that the differences came out, and glad that a
Just
lot
one
of
more thing, Hemant. There would be many things which a mutual fund may not be allowed as per regulation,
yeah.
right? Like a use of derivatives in the big, in the larger scheme of things. In case the mandate for an evolved investor is to use a strategy which an otherwise mutual fund guy cannot take, then it makes sense. Suppose you do a 5-stock portfolio, 20% each stock. That a mutual fund will never be able to deliver because of regulatory guidelines. In that case, of course, PMS is the only answer.
Absolutely, absolutely. Thank you, Shamli, for that incisive response. We'll move on to the next question that I would have. Now, again, these are certain things that we are exploring, and we would like industry leaders like you to come in and weigh in on certain things, certain thoughts, certain thought processes, certain perspectives that we are seeing, we are hearing, and we ourselves are exploring these things. So, from that, in that context, a slightly different note. Now we know that technical analysis, we use tools like all your moving averages, candlestick patterns. So let me not talk of candlestick patterns, maybe the MACD kind of analysis or a Bollinger Band kind of analysis. These are usually the tools of the day trader or the speculator, so to speak, and have traditionally been used by traders for their speculative trading. Right. So, given that, on the other hand, given that long term investment in equity, you do see certain trends or certain patterns in price movement in the long term. Right. So we still do see some similar patterns when you extrapolate the time horizon to, let's say, a 10-year, 15-year, 20-year horizon. So these detectable patterns over time, is there a case for applying technical analysis methods, maybe not all of them, maybe some of them, to long-term portfolio management strategy?
So, I'm from a school of thought where, as you rightly said, actually, initially, the trading and stock trading, which is like you enter and exit either the same day, intraday, or interday, next day, or before the settlement, or whatever. That would need, it's very important to enter at the right time and exit at the right time, because I have, even if I make some small money, the volumes I'm playing around with will see that I learned something at the end of the day. However, uh, we believe that if wealth creation is your objective, right? I think fundamental analysis is a better way to go as opposed to technical analysis, where we study the economy at large, then the industry where we are investing in, and then the particular company, because there are plenty of companies which form an industry. However, having said that, in the long run, there are certainly some patterns. They are called business cycles, right? And there is a concept of reversion to mean, right? So anything which is shooting up just doesn't go out of the roof, but it tends to come back because we invariably extrapolate either pessimism or optimism, right? So it has happened many times, and there are cycles when certain sectors become extremely expensive because of the fancy or lot of money chasing those sectors. And that's when, for a fundamental investor, those sectors become not as attractive because there is no value in the price that they are at, right? Then what they would want to do is that in the long run, they will go for growth at reasonable price. And the whole fact of evaluating the stage of markets that one is in, the valuations of high and not so high sectors, and spotting potential of companies at the right price or growth at reasonable value, this all comes as a basket in the fundamental analysis segment. It doesn't fall under technical. So normally in the for the longer term, like we have a very robust equity team, but there is no technical analyst because we don't trade, right? We have all people who study the economy for 1, 2, 3, 4, 5 years, going ahead. So for the long term, I personally feel that for a retail investor, it is better to be evaluating for the long term. And I think the way to study is study the fundamentals of a company, understand the businesses, understand the quality of management, understand their integrity, understand the segment, the growth in that segment, and of course, how the company is placed. That is a far more sound way of investing into a company or a stock or a fund than the technicals for which we have very little or no knowledge.
Okay. Now, moving on. Moving on to sectoral funds. What's your take on sectoral funds as a wealth creation vehicle? Now, as per one report last year, thematic and sectoral funds saw a net inflow of over 11,000 crores.
Very
So,
high.
how does this compare with other types of funds, especially diversified equity funds? And the second part of this is, should retail investors looking for stable long-term returns look at sectoral funds at all, or do they present some kind of risk to their portfolio, given that many sectors are prone to a lot of risk, be it regulatory risk or inflow risk, etc.
So sector funds are at the higher end of the risk, right? There's nothing wrong with it. The only difference is that it has lesser diversification because it invests in stocks in that sector, right? If you remember the IT boom of 2000, the TMT, right, where there were tons of schemes which were tech or IT or internet or whatever you call it, that sector. What happens is that the fund manager does not have the he does not have the mandate to say, boss, I don't want to invest in IT, it's looking expensive. Because he's getting the money in that particular sector fund, he will invest in the companies no matter what the cost. However, we do tell our investors to invest in sector funds to the tune of 5 to 10% of their overall equity allocation, because, as you rightly put, the last year saw a lot of inflow in sector funds. Why? Because people saw pharma go up, for example, because we were in a situation where we thought COVID would mean more medication, more vaccines, and therefore pharma would do well, right? So if you can do a timely entry, exit, and be vigilant, and if you have not exposed your 100% portfolio in that sector, so that you're not dependent 100% on the cycle of the sector, I think it does give an alpha at the right time. But I was in HDFC when 2000 happened, and I also met investors where their life savings were invested in technology funds. And the 10 rupee NAV became 2 rupees, which never regained to 10. So as long as you're taking that calculated risk of about 5% odd, see, there is one more interesting chart, I think, which I can show you, because there is a business cycle, as I said. Each sector has a time to shine, right? There are multiple colors. I'm sorry for this, but each color is a different sector. And if you see, no color is number one rank throughout, right? So something which is at the top today will be somewhere near the bottom either tomorrow or day after. If you can time that, and if you can understand what is the next leadership in terms of the sector allocations which will do well, please invest. However, if you feel that you don't have that kind of bandwidth, and if you don't have any person to guide you, then stay invested in a diversified equity, because every diversified equity has exposure to almost all the major sectors, right?
Yeah, that actually makes a lot of sense, Jamli. So it is almost akin to try to shortlist or narrow down to one stock when you talk of sectoral.
Yes,
It's almost like you're trying to put your finger on one or two stocks, and that requires a lot of fundamental analysis, like you rightly pointed
correct.
out. And that, of course, yes, it requires a lot of not only bandwidth. You need to have the aptitude as a retail investor to kind
Yes,
of get into the numbers, slice and dice them,
yes,
and keep a watch on the markets. There could be a lot of developments in the geopolitical arena that could be affecting your stock prices, even if it's a fundamental analysis that you're doing. So, and of course, there's a regulatory aspect of it. So,
correct.
all in all, I think that makes a lot of sense in terms of how to look at sectoral funds.
Correct.
And uh, so, Shamli, as we kind of wind down, as we come to the end of this wonderful talk, what would be your one mantra, one line that investors should just print out? I was thinking of this question, and the reason I'm asking it this way is that for our investors, our viewers, we are kind of trying to get perspectives from industry leaders. What is that one thing that investors should just print it out on a sheet of paper and put it in front of them, and that should be their guiding philosophy as they invest?
I think it's very difficult to put so many thoughts in one mantra or one sentence, but I'll try and make a longer sentence. Okay.
Okay.
I think you should start as early as you can, right? And do your asset allocation depending on your risk appetite as to how much equity, how much debt, how much of real estate or gold you would want, because this is a very personal call. And then stay the course and be patient. Don't listen to the noise, right? Only then will you achieve what you set out to achieve, right? So I have said four things in one sentence to stick to your
Okay.
target of one mantra. Start as early as possible after doing your asset allocation, right? And ignore the noise and stay long-term focused,
Okay.
right?
Okay. Maybe we can use four sheets of paper instead of one. But I love the lucidity, the simplicity of this mantra. I think this should hold investors, our community members. Most of them are women investors, and many of them are young investors who are coming to the equity markets for the first time. Students and freshers entering the industry, and people who are just entered the industry. So I think this simple four-in-one mantra, if I can call it that, should hold them in good stead as they start exploring equity markets. So, thank you, Shamli. It's been a wonderful talk. Great insights from you on a variety of things, and it's been an absolute pleasure talking to you. I'm sure that
Thank you.
all our community members, women members, and of course youngsters in our community today will appreciate the value of the insights that you brought in today.
Thank you so much. And since you address largely to women, I must say that women are better investors than men. I'm not being a feminist here, but I'm quoting the world's best investor who says, I invest like a woman, because they have the patience and they are more focused on the end goal rather than the journey. Because if I have to go from here to there, whether it's retirement or child education or marriage, then normally the men, and the journey is like that. Okay. So normally the men feel okay, they can buy low, sell high, do this and that, a lot of action, adrenaline. However, we have seen amongst ourselves, women are stronger in terms of their convictions and focus, and they achieve better results, statistically, at least with our scheme of things.
Okay, good to hear that. A lot of women members will appreciate that, and they'll feel these are very reassuring words for women and investors among our community. I thank you for that wonderful piece of,
Thank you.
and to all our viewers.
Thank you. Thank you for giving us a chance to connect with your your friends and your community.
Thank you, Shamli, and to all our viewers watching. Thanks for joining us today in this third installment of our YouTube series as part of the World Investor Week in partnership with uh, the BSC Investor Protection Fund. And we hope to see you all for the next talk that's coming up tomorrow. Thank you.
Bye-bye.
Bye.